This is Quint Beeler with a brief discussion on the last item I want to discuss. That is a variation on a theme. Normally we're recording interest expense because it was due and payable every 6 months. What happens if we need to adjust for interest earned by bondholders before the due date of that interest payment? So we're talking about the need for accruals, making journal entries that do not affect cash. So we're going to record a journal entry for interest expense between interest payment periods. So reporting the periods that do not coincide with interest due dates. We saw examples where interest was payable semi-annually, January 1 and July 1, every 6 months. That's a common convention. But we report our financial condition on a calendar quarter-to-end basis, March 31st, June 30th, September 30th, December 31st, and so on. So the solution is to record an accrual entry before the payment. That is, record a fraction of the interest expense and a fraction of any discount or premium write-off at the reporting date. I can use an example of bonds issued on January 1st, and before we make the first interest payment on July 1, 6 months later, we're at March 31st, a reporting date for our company. We want to issue financial statements as of March 31st. We need to adjust financial condition before we do that. Again, this is all about issuing financial statements for time periods that do not correspond to an interest payment due date. Again, let's assume that our bonds are issued on January 1st with interest payable every 6 months, but we're at March 31st. We want to issue financial statements. We need to do a 3-month adjustment or accrual. This is not a payment, but a recording of an expense and related liability between interest due date periods. So our illustration, Candlestick issues $100,000 5-year 10% bonds at 100 total face value. Let's assume that interest is payable, as I mentioned, January 1st and July 1st, semi-annually. Let's prepare the journal entry to record the accrual, not the payment, the accrual of interest expense on March 31st, 3 months later, 3 months after the issuance of the bonds, just before our quarterly statements are prepared. What's our journal entries? Interest expense, debit, $2,500. Interest payable, credit, $2,500. Increasing expense, which reduces owner's equity, and crediting interest payable, which increases liability. There's our calculation. It's always best, in my opinion, to make an annual calculation of interest because the percentage of the expressed on the bond, the 10% coupon rate is always expressed as an annual percentage, 10% annually times $100,000 face value, $10,000 annual interest cost per year. Divided that by 12 months, and then multiply that times 3 months to arrive at $2,500 for our accrual purposes. Again, we're only adjusting for 3 months, not the full 6 months interest payment period. We'll pay a full $5,000 semi-annually, but the adjustment above is only for 3 months at March 31st to get our financial statements reflecting the proper condition at that time for expense and liability. We're going to take the last example but modify it. We're going to modify it for selling the bonds at a discount, not full face value. So we're going to get $92,639 for the sale of the bonds, not $100,000. The discount, therefore, is $7,361, the amount that was not obtained by the corporation because it was sold. The bonds are sold at a discount. So again, similar to the last example, but we're introducing a discount on bonds payable into the problem. We need to amortize or write off a portion of the discount for the period of time involved. This systematic write-off of the discount, as we are aware from previous talks, will affect the interest expense recognized by the issuing corporation because the discount is paid back at maturity and so therefore it presents an additional cost of borrowing. We'll combine that with the normal cost of interest that's earned by bondholders. So what's our journal entry? Interest payable, credit, $2,500, 3 months worth. Normal $5,000 every 6 months, one half of that, that's what's earned by bondholders as of March 31st with the issuance of the bonds at January 1st. Discount on bonds payable. We're taking out $368 credit to discount on bonds payable. Again, normally it's a debit account. We are amortizing a portion of that systematically. 1/10 of the discount is $736, but I'm dividing that by 2 because of the 3-month period. The 1/10 relates to every 6 months. These are 5-year bonds paid semi-annually. So I'm taking the 1/10 and then halving that to get my 3-month adjustment to the amortization entry. Add those two amounts up, interest expense, $28.68. Again, interest expense is always calculated last whenever we have any amortization of discount or premium. Again, we're not making an interest payment at March 31st, but we need to get the financial condition accurately stated before preparing financial statements. Please understand how I got the $368 adjustment to the discount account. It's 1/2 of the normal 6-month adjustment. To conclude, our need for accruals is updating financial condition between interest payment due dates. We need to get our interest payable for the period involved correctly stated. We also update any amortization of discount or premium for the period involved, and then calculate the effect on interest expense, which is a combination of the previous 2 entries, to be recognized for this period. That balances the entry. Calculating interest expense is the last thing that should be done in an accrual entry that involves any discount or premium amortization. How? By using fractional amounts of the normal semi-annual adjustments. This can be anywhere from 1 to 5 months, all depending upon the circumstance of the data, when the bonds are issued and when the next reporting date is for the corporation.